You know, young rich niggas.
So today I'm just focusing on one chart, the volatility index chart, and I just want to quickly explain how we can use the volatility index chart as Forex traders to quantify our risk. No, after all, trading is about risk, and if there is a piece of analysis that can help you reduce the risk to a trade, then it is very important that we use it. Not to take trades, not to provide buy and sell signals, but to simply quantify the risk. So this is the volatility index chart, the price chart from 1990, and the volatility index is the investor fear gauge, because the index reveals sentiment and risk appetite in the stock market. You can see it's the volatility index S&P 500 index. This is because the volatility index, or the VIX, it uses option prices from the S&P 500 companies. And in the options market, that's a whole other market, and maybe more about the options market in another webinar. There are two instruments in the options market. There are the call options and the put options. So the VIX is constructed in such a way that it looks forward in the next 30 days and tries to forecast the likely volatility of this SP 500 index using these put options and call options. So what are these put options and call options? A put options increases in value if the underlying asset falls. Okay, and a call option increases in value when the underlying asset rises. Okay, so if we have more put options being bought, it means that the investors are fearful and they are buying these options to protect against a falling market. So the VIX will rise. So if we have more put options than call options, that's when the VIX will rise. Okay, because a put options increases in value when the underlying asset falls. So when the stock market is falling, the VIX will be rising. That is what I mean. But what if we have more call options than put options being bought? Of course, that means that the opposite will happen. The VIX will be falling. So when the VIX is at very low levels, like here, say below double digits, that's below 10, or it at the extreme levels. So at the very low levels, it means that the investors are buying equities because we have more call options than put options. But at the extreme of the other end, at the very high levels, it means that we have more put options than call options. So the equity market will be falling. Okay. And another thing to know is that the lower the VIX goes, the more likely the stock market will reverse from bearish to bullish. And the higher the VIX goes, the more likely that the stock market will reverse from bearish to bullish. Because at very low levels, the investors are heavily buying, and at high levels, the investors are heavily selling the stocks. So as you can see, the range usually at around this price level that we are at currently, that is the 10 to 20 area, or below the 10 to 20 area. Currently we are at 16. Of course, this means that the stocks are being bought. The investors are taking on more risk. But the lower we go, if at all we will go below 10 or around 10, but even in the current range, it means that the stocks are being bought heavily. But the lower we go, the more likely that the trend will reverse. So I don't think that the stock market is set for a bull run just yet. Because now the VIX, as you can see, we are almost at very low levels. Okay. So at some point here, we'll be looking for a market reversal in the stock market now, from the current bullish trend to a bearish trend. So when the VIX starts to rise, the stock market should fall. Okay. But on the other end, when we are at very high levels, like these are extreme levels. So you can see the August we earned 86. During the 2008 financial crisis we earned 89, 97 I mean. But usually, as you can see, the range is usually around 40 to 50 in normal circumstances. Of course, in these two instances, of course, this was the financial crisis in 2008. This was during the COVID time. But under normal circumstances, around 40 to 50. Now, that's when we should be looking for a reversal in the stock market now. Okay. So when the VIX is at these levels, it means that we have more put options than call options. And around 50 price range, 40 to 50, no, the investors will be heavily bearish. They will be heavily bearish on the stock market. And this is the point that now we should start looking for a reversal from now bearish to bullish. So at the current levels, currently where we are, we cannot expect a bullish stock market, and yet the volatility index is at very low levels. We have more call options than put options. It means that the investors are fearful, and right now almost everyone is buying stocks. And when everyone is buying stocks, now who will be left to buy? I mean, if everyone is bullish, it means that there is no more room for advancing, or it means that now we are almost at a turning point. in the stock market from bullish to bearish. So this is going to be a very bearish year, or the next 2 years. At some point, we're going to see a stock market falling, and these analysis on the VITs, that's what it helps us to do. So in summary, when the VIT is very low, like currently, it's time now to start looking for a sell in the stocks. But when the VIT is at high levels, that's when we should start looking for a reversal from bearish to bullish.